Hi there, welcome to our presentation. It's Andrew Parker, Ryan Chamberlain and Sam Sherratt. We're going to talk about the trading and profit and loss account.
Within this presentation, we'll be talking to you about the definition of the trading profit and loss account and what it is. Then we'll be giving you a short video explaining the trading and profit account and all the elements behind it, a typical profit and loss account, and also the 5 key areas within that, and explain what they are. I will be telling you about the importance of the trading profit and loss account within finance. We will also then be telling you of which other areas of finance the trading profit and loss account is involved in. And then finally, we'll be giving you a sporting example about the trading profit and loss account and how this is differed and what is involved for a sporting organisation.
A trading profit and loss account definition: an account in the books of an organisation where incomes and gains are credited and losses and expenses debted over a given period. The trading account is used to determine the gross profit or loss of a business and used to indicate how much they match their sales revenue for a certain period with the cost of those goods sold for the same period. This can be represented in this simple equation: gross profit equals sales revenue minus cost of goods sold.
The profit and loss account of a company shows the incomes and gains credited and the expenses and losses debited. Simply, this can be how a company matches a total revenue, income and expenditures for a given period. This can also be illustrated in the simple equation of net profit equals gross profit plus other revenue income minus revenue expenditure.
Here is a short video briefly explaining a trading profit and loss account.
Welcome to the Investors Trading Academy talking glossary of financial terms and events. Our word of the day is profit and loss account. This report is simply called P&L and is one of the most vital business reports issued. It's one of the 3 principal business reporting and measurement tools along with the balance sheet and cash flow statement. The P&L is essentially a trading account for a period, usually a year, but can also be monthly and cumulatively. It shows profit performance, which often has little to do with cash, stocks and assets, which must be viewed from a separate perspective using balance sheet and cash flow statement. The P&L typically shows sales revenues, cost of sales, cost of goods sold, generally a gross profit margin, sometimes called contribution, fixed overheads and or operating expenses, and then a profit before tax figure. A fully detailed P&L can be highly complex, but only because of all the weird and wonderful policies and conventions that a company employs. Basically, the P&L shows how well the company has performed in its trading activities. The statement of profit and loss follows a general form as seen in this example. It begins with an entry for revenue and subtracts from revenue the costs of running the business, including cost of goods sold, operating expenses, tax expense and interest expense. The bottom line is net income, profit. The balance sheet, income statement and statement of cash flows are the most important financial statements produced by a company. While each is important in its own right, they are meant to be analysed together.
There are 5 key areas in the trade and profit and loss account. These are all vital to every business to enable the company to run efficiently and check how profitable the business is as a whole. The top one is sales. That means the quantity of stock sold. Number 2 is the cost of sales. That's how much it costs to make and manufacture. Number 3 is gross profit. That's the value of goods sold before interest and tax. Number 4 is expenses. That is the cost that the business has, e.g. wages, bills, office costs, etc. And the last one is net profit at the bottom. That's the actual profit after working expenses, etc. have been included.
Areas within the business that actually contribute to the profit and loss account can include advertising, discounts allowed and discounts received, the electricity bills, interest received, purchases and purchases returns, sales and sales returns, stationery and wages. The trading profit and loss account is very important to potential investors and credit sources, as it indicates how effectively the business is running and how it generates its revenue and manages its costs. It is important to compare the profit and loss account with a cash flow statement, as under the accrual method of accounting, revenue and expenses seen on the trading profit and loss account can be logged in before the cash for the transaction is actually changed hands. Further advantages of the trading profit and loss account is that it highlights the operations of a business in terms of net profit or loss. This enables the company to compare the profit of the current year of the business against the previous one, therefore helping the company to know whether it's running efficiently and using its resources effectively to reach the optimum of the company's potential. This will help the company controlling any indirect expenses need to improve in the profitability of the business as a whole. Furthermore, it provides relevant information for determining wages and bonuses for workers and managers, and indicates how much tax is payable to the government. The trading profit and loss account is also involved and correlated with other areas of finance, such as the gross profit ratio. This is the percentage of gross profit or loss on net sales which can be calculated using the trading account. The purpose of the gross profit ratio is to measure the success or failure of a business. When comparing the trading account to the previous financial year, success is indicated by an increase in the rate. In contrast, if there is a decrease in rate, this indicates a failure for the business. There is also a direct correlation between the profit and loss account and the balance sheet, as transactions in the profit and loss account affect entries in the balance sheet and vice versa. Contribution break-even analysis and the contribution model within this is also predominantly based upon the profit and loss account. As we already know, the profit and loss account's 5 key areas are sales, the cost of sales, gross profit, expenses, and net profit. For the contribution break-even analysis, the model is as follows: sales, total variable cost, gross contribution, fixed costs, and net contribution. Here is a sporting example of the trading and profit and loss account. The trading profit and loss account here includes the figures of the previous financial year for CCFC. So here we have sales for £100,000, cost of goods sold within purchases £60,000, which means the gross profit overall is £40,000. No expenses taken away from that, which is £10,000, leave you with net profit of £30,000. So in terms of a sporting organisation, the sales figures would relate to the stock sold at the club. This would include sales of shirts, scarves and various other merchandise sold at the club, shop or online, tickets sold for match days and hospitality boxes on those match days also. The cost of sales would include the cost to manufacture all the merchandise said above, the printing of the shirts in order to sell the goods. Gross profit would be the value of all merchandise and tickets sold added together. The expenses of the sporting organisation would involve the costs of the organisation, including computer expenses and office bills, and all of the wages of all the staff at the club. Finally, the net profit of £30,000 is the actual profit the club have got after work and expenses.